until market opens. I'm going to be talking about transitioning because we've talked a lot about transitioning, or I've brought it up a lot. And a lot of times it's like, okay, so you're telling me that I should take profit and then enter a new position. What the hell do you mean, right? So I've got charts. I'm going to load up here in a second. We're going to use DT as an example, right? We're going to use DT as an example. So we had this chart. We had a wedge that we traded to the upside and then charted a diamond here to continue. And if you see from where this started, I'm just going to just lay the groundwork. Price came out of the breakout, consolidated a little bit further down into support down here, tightened, and we had an obvious day that we were watching to enter price, which is over here on the February 2nd. On a trade like this, you've got a trend line in here, right? So whether you entered here on the first, I didn't enter in the first, I entered on the second. You could have entered on the first because this trend line through here that you can of course see. But I waited for the second and I was looking for this trend line, right? I always talk about if price is above the pattern trend line, then the breakout is still there and the pattern is valid, right? So this target would be valid still. So I went ahead and entered here on at 43, a little above 43, about 43 and a half on this breakout here. Now, you guys know me, so I buy at the money. I bought at the money February's here. At the money February's here, okay? So you buy at the money February's, and guess what? Sort of like this morning, you got a nice gap situation here. I'm gonna just turn the magnet off to show the actual percent. You got a nice gap here of about 11.5%, right? Now, that's a pretty great return in one day. And it's certainly not something that you were expecting when you entered here on a break. You know you're entering on a break because there's a chance of a lot of upside. So that's why we were entering. But you certainly were given a bit of a gift here and you want to take advantage. You are coming up into supply here. We have a resistance level that I marked here. It's something to keep in mind, right? So if there wasn't resistance here, I wouldn't be thinking about transitioning. So again, when we talk about transitioning, you're transitioning when there is a level of supply, whether it's a horizontal or a trend line. So for instance, up here would be another transition point on that trend line. For now, you've got an open at about 48.5, and you have a level of resistance immediately above you. In this situation, if you entered down here at 43.5 or so, and you bought at the money February's, which is sort of the play, of course, you'd make here, and you'd also, in this situation, if we were going a little bit longer term, you'd have Marches as well, right? But in this situation, I only had February monthlies at 43, okay? In this situation, I'm guessing you guys can see by now that from here to here, you're deep in the money. You're pretty much, you're in the money, and you've got significant, you have significant value here, intrinsic value, right? In this situation, wouldn't you love to have new contracts that give an exponential here? So now I'm going to switch the screen over. Think about where this chart is here, right? Just think about these two candles in this gap and that there's a level of supply here. And I'm going to bring the chart over now. Let me see if I can, I'm going to switch the screen real quick. Change windows. Okay. Let me make sure you guys can see this. Looks like you got it. Let me switch over this screen as well. Give me 1 second. Okay, everyone should be able to see this here. Okay, now I'm using just the bar chart website. It has all the up-to-date options and everything. This is a pretty good website. I do not have the ability to use IBKR obviously on the stream, so we're going to use this website. Okay, so here's the 43 monthlies from DT, okay? What I've already done is I've already shown you, I'm going to show you the profits and everything. This is what the option chart looks like. This is the second when I entered. Over here, the entry was 247, okay? This is 247 on the second. So again, on this is the day that I entered on the break. This is before the gap happened, okay? From here and on to the next day after the gap, price from here to here, open to close was about 247 to 731 here. If you take that profit there, that's about 500 bucks. That's about $500. That's a pretty good gain there for one contract, right? Your price point was 250. You sell at 730. whatever, okay? That's just the gain from here to here. The point here of transitioning that I'm going to talk about is it's the risk reward of from this third after the gap up into where price is now. And so I'm going to show you multiple different charts, and we're going to see what is the best strategy. Is it to stay in this position from here to here, where you already gained $500, or would it be to realize the 500 and then enter new contracts? So I'm going to show you the differences here. So one, this is the position you're already in. You're up $500 by open, right? You're already up $500 by the time the market opens on the 3rd. You're now sitting on $500. You could keep that unrealized and continue to push the position. And if you push the position to yesterday, right? To yesterday, you would have made another $572 or so, okay? That's a pretty good gain from here to here as well, right? It's about the same from here to here. This is a pretty good gain if you think about it in general. And so in this situation, even though the delta is pretty close to 1, you actually get a pretty good amount of profit. But what you're risking here, to push this position from this gap, what you're risking is that at that level of supply and the rejection that could possibly come, you're risking the $500 that you already have. So your question here is in terms of risk reward, should I take this profit from my open from before to here? Should I take that profit now and look to re-enter new contracts? So here's where the transition question comes in and how I'm going to show you the answer and why it's important to see this. And it's going to be a little, you're gonna have a question, and I'm gonna show you why this is the correct way to do it. So here, you want to take profit on your February monthlies. These are the 43s. You're going to take home $500. So you just profited $500, okay? Now, do you want to rebuy the 43s here? Do you want to rebuy the 43s and make the 572 here for the price point of it, like another, it's almost $7? Or do you want to go ahead and go a little bit further and go to where the at the money is now? The at the money would be, the price was at 49. So the closest at the money is 50. From 50, if you buy from that 50 open, so you take profit, you get $500 on the other contracts. Now you switch to February 50s. The price point is only 216. Now if you take a look at the profit, a nice solid 420 from here on the 3rd to the 8th. So this is the same price. This is the same timeline from the 3rd to the 8th is a $420 profit. Now you're going to say, well, isn't that less profit than the 572 over here, man? You're right. It is a little bit less profit. It is a little bit less profit. So why wouldn't you want to keep this position? Why? Because you want to take that profit home, and you don't want to have the higher price point. You want, this is a $2.16 price point when this one is a $6.70 price point. So the difference here is that your price point is lower, and so your risk has been reduced, and you've already taken home $500. So you've already got a $500 gain, and now you're entering at a lower price point. And the profit here, albeit a little bit less than here, right? It's about $100 less. The reality is you've already taken $500 home, so you've taken the risk off, and so your reward might be a little bit less, but you've taken the risk off. And the other important part here to mention is the volume. If you take a look at the difference between the 43s here, the volume here, and the volume here, it's significantly different. So there's a significant difference. The volume here is in the thousands comparatively to here being only about 250. And so the difference here is that you're also going to be able to get filled, and it's important to see the difference there as well. So of course, the at the money contracts at that moment are going to have higher volume, and you need higher volume, or guess what? You're not getting out of the position, and you're probably not going to get the contracts that you want in the first place. So sometimes that does come into account where you're in a position now that's illiquid and you may not even get a good price point. So the further it goes, the less of a chance you can get out of it. Take a look over here. On the 8th, there was only one contract that was actually traded, right? And so you had to have known that on the 5th you need to take profit. That's not a good way to play it. So you want to continue to go further and further. And I'm going to give you another example here is on 55s. If you went even further out of the money, the price point here was under $1, and there was contracts to pick up, so you can even gradient a little bit more and actually put on something that has a little bit more risk, but you might have gotten a larger position in. In this instance, though, you can see that the profit potential that actually came out of it, it's not a good price point because it was too far out of the money. So again, I talk a lot about you don't want to be buying too far out of the money, because guess what? Even for the risk you're putting on for how out of the money it is, you're not getting the reward. So from the 3rd here to the 8th, again, these prices here are all the 3rd to the 8th. You only get $200 comparatively for the out of the monies, even though you put on significantly more risk from the $50, right? And so in that case, you went too far. The way you can see this is through the price and through the Greeks themselves and the deltas. So if I bring it over to just the chart over here, if we actually look at the Greeks themselves, and comparatively, if you look at where these prices are now, take a look at how the 55s compared to the 50s, the delta, see the change here? You can already see how significantly different these two contracts are, and this is on today. This is from today's numbers, or technically from yesterday's close numbers. There's a significant change. Now the volume is here now, right? So you're going to see these change. So now where price is, and we're going to go back to the chart, I'm going to show you where the price is now, why these are now the hot item to be in, which are the 55s. But at that point on the 3rd, on that gap, it was the 50s that you'd want to transition into. But now with that trend line, you can see the volume difference over here. It's important to see how this has now become that transition point. So if we were transitioning now, we would be transitioning into 55s, not only because they have significant volume, but look at the delta. This is your exponential, right? For every underlying point move, what you're going to make on the options. Your 50s have a delta of, now this is 90, this is going through percent, but of 0.9 compared to just 0.6 over here on the 55s, which are now a better price point. 267 compared to 637, you're paying less and you're taking profit on the 50s, which would be on that trend line if it was right now. But again, we're looking at from the 43, you took profit on $500. This price point, you don't continue, even though you could have continued here. Yes, sometimes you're going to keep pushing a position, but this is an example of taking off the profit, taking the profit home, risking none of your money to get into a new position. The last thing I'm going to show are the marches. If instead you went ahead and pushed into March, even less risk, right? Look at the profit potential here for if you bought at the 3rd and took profit on the 8th. You're extending an extra month, and guess what? You're getting a better profit on the marches, which is the real thing that I talk about, which is don't cut your legs off, right? You can see it in the profit potential here. This is the $48 call. This would have been directly at the money at that open. It would have been better for you to get marches even compared to the February 50s. That's how significant the difference is on the timeline from here to here. And here's the 50s. Even the 50s at that same price are better for the March expirations. And that's what I talk about. If you're in February, you were in these February monthlies for 43, take the profit and add on. You see the move is happening, right? You see the move is happening. You know how to read a chart. Get out of the Februaries. Those expire in 2 weeks, and go grab Marches, because you'll be able to push the March further and you'll be able to get more value. The only thing here is that there's a little bit less volume, so you're going to need to lever between multiple contracts, 48, 49, 50, grab what you can, but you can already see the difference here is that you're going to be able to push this position longer than on these Februaries. These 50s are going to lose value today probably. So switch, transition, take the profit, realize your gains, and transition to new contracts that are at the money. And importantly, if you can switch to the next month and give yourself more time, you're going to be able to make more money because of you're not cutting your own legs off. You'll be able to push a position, and you can see it in the value in the options themselves already before a move has even happened. Because again, this is all speculation. So again, it depends, but keep this in mind, because again, it's extremely important to understand when you're risking too much by just keeping money on the table, right? Anyway, that's what we got. I tried to wrap it up right before.